Hello, ladies and gentlemen. Welcome back to Reserved Investments. So it's been a while since we talked about auction psychology, since we talked about the emotional effect of investing or allocating capital to the antiques and collectibles trade. So that's really what I want to talk about in today's video. So always remember, if you're new to this channel, if you're new to what I teach, there's two quotes that I say quite often, not only on this channel, but also through the articles that I write through Antiques and Auction News. The first quote that you got to keep in mind is, the only constant in the entire antiques and collectibles trade is change. All of these markets, I don't care if it's the market for rare coins, I don't care if it's the market for Pokemon cards, I don't care if it's the market for high-end art or something stupid like Beanie Babies. These markets are always changing and evolving right before our very eyes. What is hot, what is popular, what is in demand today is not necessarily going to be in demand 5, 10, 15, 20, 30 years down the line. And this is what a lot of newcomers to these markets do not understand. This is why if I put out a video talking about modern era Pokemon products and the speculative nature of those items as assets, I will get attacked relentlessly by Timmies, Kimmies, and Poindexters who do not understand the long-term trajectory of the antiques and collectibles trade, how these markets are always changing and evolving. And if you have a market that is ultra hot, if you have a market that is in either a speculative bubble or a speculative frenzy, that should be your sign to sell into the hype, not buy into it, especially if you're holding those items over the long term. There is a such thing as overhyped markets in the trade. We saw this with what happened with graded video games. Those of you that were with me in the beginning, when I started talking about Wada Games and the run-up in graded video game prices just because they appeared on the scene back in 2018, 2019, I told you guys that market is unsustainable. That's why if you price chart most of those graded games that sold for significant comes, they have pretty much dropped in price anywhere from 20 to 80% on average. That was an unsustainable market at that particular point in time. Now, this is an important lesson because another quote that I say often on this particular YouTube channel is price is what you pay, value is what you get. So for instance, I'll use the Wada Games example here. If a newfangled graded video game company comes out of the woodwork and prices start escalating in value and you decide to buy into that market, if you're paying a premium for that item simply because an auction company and a newfangled grading company told you that the market's hot, do you really think you're getting a lot of value for your money in that regard? Because keep in mind, you're buying at the height of the market. This is why you have to apply logic to this market. Even though when we look at the antiques and collectibles trade, it is an abstract, speculative market based on emotion. I've said this before on this channel, and I'll say it again. And again, this is a quote that a lot of the Timmies and Kimmies and Poindexters out there get upset with. Nobody gets emotionally attached to an S&P 500 index fund. I'm sorry to tell you, if you are somebody who is tuned into your brokerage account every single day, staring at the number that you have invested in an S&P 500 index fund, you, my friend, have taken on too much risk. It's more risk than you can tolerate. That's why risk tolerance is a thing that you got to understand to become a viable and successful investor, whether it's investing in financial assets or investing in alternate asset classes, whether it be antiques, collectibles, cryptocurrencies, Bitcoin, gold, silver. You must understand risk tolerance. Now today, what I really want to talk about is the interesting conflict of interest that plays out between the seller of a said collectible versus the buyer of that said collectible. You see, in any market like this, we have a unique dichotomy. The seller wants the most for his treasured collectible that he is trying to sell. Meanwhile, the buyer wants to pay the least amount possible to own that item. And this sets up an interesting dichotomy where in order for a sale to take place, you have to have a willing buyer and a willing seller. This is why negotiations are everything when we get to the core of buying and selling in the antiques and collectibles trade. Now, of course, you could use an auction site. You could choose to list the item yourself on eBay. You could attempt to consign it to either heritage auctions, Hakes auctions. If you have something really, really valuable, mainly a piece of art, you could go through Christie's, Sotheby's if they agree to take the consignment. Then, when we're talking about an auction dynamic, you have a buyer. You also have a seller, also known as the consignor, who is working with the auction company to negotiate that sale. And they do that through the use of an auction typically. So typically an auction is a structured format where that item sells at a set price that is made within the time that that item is up for bid at auction. Of course, I'm sure you all know that. I'm not saying anything revolutionary by stating that. But this plays in to two concepts that we got to take a deep dive in. If you're a seller of a collectible, you must understand something called the endowment effect. The endowment effect is an economic theory that pretty much states that the owner of a collectible or an antique item, they tend to overvalue the item, making it harder to sell it for a fair price. And I have clients who are hardcore collectors and investors that utilize my consulting services. And this is why when you guys come to me and say, hey, Sean, how do I know if I'm ready to sell? This is a whole other conversation. This is where we have to have a one-on-one, heart-to-heart conversation to discuss. Because if you truly are ready to sell, ready to let go, you may have a price in mind that you want to get for the item in question, but that price should be negotiable to a certain degree. Now, this is where the endowment effect can really get in your way. Let me use this as an example. Let's say that you have a comic book that you once loved and cherished. You paid $3,000 for that comic book. You go, you look up the current value of that comic book on either Go Collect or GP Analysis, or you do your own price research, and you come up with the realization that that comic book is now worth roughly $5,000 on the secondary market. Now, chances are, if you're spot on in that analysis and you're willing to let it go for $5,000, you can probably find a buyer who will pay you $5,000 for that item. The problem is there's a lot of sellers out there that say, you know, I understand that I only paid $3,000 for this. It's worth $5,000. I honestly want to get $6,000 or $7,000 for this item. And there are people that have this mindset. And usually if they're a client of mine, I will flat out ask them, why do you think this item that we know, based on all completed and sold sale listings in the last 30 to 90 days, that show this item is only worth $5,000, why do you think you should get $6,000 or $7,000 for this item? And they'll look at me and they'll say, well, Sean, you don't understand. I have a lot of time invested in this item right now. I spent months scouring the internet and auction sites looking for that item in that grade with that said page quality so I could add it to my collection. I think I should get compensated for my time. And I'll usually say to them, well, you paid $3,000 for the item. It's now worth $5,000. That $2,000 profit is your compensation. You don't get more just because you think in your mind you put more effort in than most other collectors, buyers, investors, or the like. This is where the endowment effect can get you into trouble. because I have had clients of mine where they have an item like that. Somebody comes to them and says, you know what? I believe that this particular piece that you paid $3,000 for, that you want $5,000 for, is going to end up going up in value over the short term. So there are people out there that'll say, you know what? I'll give you $5,250 for that item. And are you aware I have clients that still won't sell it, even though they're getting more than fair market value for the item? This is the endowment effect in action. You have to be very careful as a seller to not get caught up in this type of mindset. Now, obviously, it's a little bit of a different set of emotions. If, let's say, that you paid $3,000 for an item, you're thinking of selling, and now the market value of that item is $2,000, meaning you're going to take a $1,000 loss. Always remember that the pain of a loss is felt more strongly than the pleasure you feel with a financial gain. So if you lose money, it is very painful indeed. Now, let's flip this on its head. Let's look at this from the perspective of a buyer, a would-be buyer. There is something called the sunk cost fallacy that gets a lot of buyers of these items tripped up. And an excellent example I can give you to illustrate this in action is how auction companies promote a lot of the items that they have coming up for bid. If you subscribe to either like Hakes Auctions or Heritage Auctions, and you get their communication emails, or maybe you just from time to time log onto their website and you notice that they have an upcoming auction. So you take the time and you scroll through all the listings and you see some things that you're interested in bidding in. What can really get you into trouble is if you're one of these Timmy's, Kimmies, or Poindexters that likes to quick put a bid in right at the start of the auction, that can really lead to you overpaying for the item in question. This is why I always tell people, if you are bidding in an auction, I don't care if the auction has extended bidding procedures in play. You need to wait until the very last minute to put your bid in. Because if you do that and you come in with a plan and a set max price that you're going to pay for that item, you will never, ever overpay for the item in question. Meaning if you're looking at a vintage Star Wars figure and you have it figured out that the market value of that item is roughly $3,000 and you don't want to pay a penny more, if you come in at the last minute, you put in a well-heeled bid of $3,000, including the buyer's premium, and you don't win it, guess what? You're really not out that much. It took you probably 10 minutes to do that market research, and all you had to do was tie up probably a half an hour of your time. When that item came up for bid, if you waited to the last minute to put that bid in. There really is no sunk cost fallacy there. Where Timmy's, Kimmies, and Poindexters get in trouble is when they fall in love with the item. They look through the auction catalog. The auction goes off, and every single day they log in and they watch that item. And they see people put bids in. And they get nervous, and they think they're going to miss out. So what do? They start bidding against themselves. Always remember, if you put a bid on an item in an auction too early and you place multiple bids and someone comes along and outbids you, you are technically just bidding against yourself. You are not doing you any favors. The correct way to place a bid in an auction is to wait until the very last minute. Preferably, you should be online when that auction ends. That is the best way to ensure you don't have too much time or investment in the item in question and you're not overpaying for it. Because if you come in with a plan where that item is only worth $3,000, I'm only going to pay $3,000 and I'm going to only put one bid in towards the end, you will never, ever fall to the sunk cost fallacy, which is very dangerous for buyers. So to quick review, sellers have to worry about the endowment effect. They tend to overvalue items that they already own in their possession, in their collection. They look at it and they go, well, gee, this is a rare piece. I remember how long it took me to find one of these items, to bid on it, what I went through with price research, with trying to sell this item. I want to get compensated the most for this. Buyers on the flip side, the more attention and time they spend envisioning themselves owning that particular piece, spending a lot of time going back and forth, watching the item, putting bids in early, they fall prey to the sunk cost fallacy. So if you understand this from a psychological standpoint, you can learn to override your emotions and make sure the antiques and collectibles trade from a financial investment perspective works for you more than you working for somebody else. Meaning, if you overpay for an item, guess what? The person you bought that particular item from got one hell of a deal. Always remember that, guys. Price is what you pay. Value is what you get. Let me know your thoughts in the comment section below. If you are subscribed to this channel, I just might see you in another upcoming video.